Nigerian government has tasked its economic management team to develop a roadmap that will unlock rapid and sustained inclusive growth with a 7% medium-term growth rate. Meanwhile, the Federal Executive Council approved a bill to the National Assembly to set up a cocoa management board. Tilewa Adebajo, the CEO of CFG Advisory, joins me now to discuss these stories and more. Thank you so much for your time today, and I'd like you to speak to this new charge for the economic management team and what are some of the upsides here?
Well, I think first of all, it's good to see that the economic management team is now back in the forefront because we hadn't really had much from them quite recently. So, without a doubt, I think the key challenge for the Nigerian economy now is growth. We've achieved some degree of stability, and it's important that we build on that growth because the 3% growth we're seeing is suboptimal for Nigeria's population of 200 million. And for us to see meaningful development and lift people out of poverty, we look to see at about an 8 to 10% growth on a sustainable basis. And I think we are looking to see inflation in the region of 9 to 12%. That is what is optimal for Nigeria.
Yeah, because in terms of what they're looking to also prioritize, because we've all talked about that confidence challenge with bringing in investments and FDI into the country. I'd like you to speak to that in terms of, because now they're looking to strengthen Nigeria's credit rating, and it's quite a long journey to get to investment grade.
Yes, without a doubt, but I think there are baby steps you need to take. Most of it has to do with more structural reforms. If you take a look at how you reform the monetary side, the fiscal side, and you need to also coordinate both your trade and investment and industrial policies together. Once you begin to see some sort of coordination with that, and we reach 2014 levels of inflation and interest rates, I think you can begin to see more credibility coming back onto the system. And I think there are efforts being made at the moment to get us back onto the JP Morgan bond index. If we can get on the JP Morgan Emerging Market Index, then I think it positions Nigeria strongly also in terms of improving the reputation and credibility.
Yeah, because we saw that recent upgrade from Fitch, and there have been some positive talks on the reform agenda of the president, and there's still quite a lot of positives there. But it's still not all yet uhuru yet. There's still some certain areas that need to be worked on, and I'd like you to speak to some of the areas that you think we should prioritize in the medium term. Well, if we're going to achieve 7%?
Well, the first thing we need to do is to complete the fiscal space. I think what is happening now is that a lot of our crude has been sold forward. We've seen a lot of forward contracts with the crude sales. I would like to see an audit and reconciliation of these contracts, and I would like to see all of them collapsed into a more structured loan, maybe like a 5 or 7 year bond. Maybe to the NNPC, so that we see transparency in the repayments of these receivables. That's very important. And like I've said earlier, it's time to begin to optimize equity within the capital structure of the federal government. And you know that I'm an advocate of selling down JV assets to raise about $30 to $50 billion to more or less refinance the government's balance sheet. And by the time you do that, in terms of restructuring the federal government of Nigeria balance sheet, then you can begin to see better credit ratings.
Yeah, it's good to look inward, but it's also good to understand what's happening globally, especially when you look at oil prices as it is now. Where in that environment where we're seeing projections coming for this year and next year, we're not seeing oil. Most projections are not seeing oil even reaching $70 per barrel, and that poses a significant challenge in terms of how the Nigerian economy is structured. And I'd like you to speak to that in terms of how we could, navigate that challenge.
Just before the global financial crisis, Nigeria had an excess crude account in excess of $25 billion. But there was pressure from the subnationals, including two governors, Fashola and Amechi, that took the federal government to court, insisting those funds should have been spent. If at that point in time we had put the money into a sovereign wealth fund, which we do have now, there's a stabilization fund within the sovereign wealth fund of Nigeria. And that is what the excess crude account should have transited into. So what is important now is that we should stop talking about oil price fluctuations in the world, because if we create and fund our stabilization account, Norway has a sovereign wealth fund of $1.2 trillion, and last year alone they made $250 billion from that. I can talk about what Saudi has, what UAE has, and all the other oil-producing countries in the world don't talk about fluctuating oil prices anymore. They've hedged it out with their sovereign wealth funds. So we need to do the same by looking at the stabilization fund within our NSIA and work on that. And Nigeria's problem is not really oil prices at the moment. In 1977, we were pumping out 2.5 million barrels of oil a day. Right now, we're at 1.4, and investments have dropped from a high of $22 billion a year to just about $3 billion last year. So now we're seeing a lot of changes in the oil and gas industry, which is positive. The new CEO has looked at re-entry for their drilling program, and we're seeing now that the oil rigs have now increased from 18 to 38 rigs, and the NUPRC is expecting 50 rigs by year end. So what is important for Nigeria now is to continue the oil and gas reforms to be able to get production back to 2 million barrels a day. So even if oil is $50 a barrel and you're pumping out 2 million barrels, you'll be making more money than if you were only producing 1.2 million barrels. So I think we need to sustain the reforms in the oil and gas industry. And that's why I'm saying that by the time you sell the JV assets, the government can raise an additional $30 to $50 billion to help it restructure its balance sheet and optimize equity within its capital structure.
I'd like to take the conversation to some of the fallout that we saw from the Federal Executive Council meeting yesterday, and quite a number of them struck me because I remember in our previous conversations we've talked about Nigeria having a coordinated policy in terms of fiscal, monetary, and even trade policy, and I'm seeing that story talking about the government approving the Nigeria First policy to support local industrialization. I'd like you to speak to that and why such a direction is important for Nigeria at this time.
Well, it is, because you see what we're lacking now is the industrial policy. And it's impacting our tariffs. China is the country we import the largest from, $25 billion worth of imports from China. And China is a highly competitive economy when it comes to manufacturing. So they will be dumping products into our economy. And so it's important that we understand our industrial strategy to be able to make our industries more competitive. So what is important is that we need to structure our economy and tariff structure in such a way that a lot of those Chinese companies come to Nigeria, find Nigerian partners, and invest in manufacturing in Nigeria. So a significant part of that 25 billion that we import every year has some serious local content, and we can use that opportunity to develop our industrial base the same way the Chinese have done.
Yeah, because I'll even bring it into agriculture as well, seeing that we're looking to establish a national cocoa management board is very critical now. We've seen Ghana had told the same line. In fact, their board was inaugurated, started work just this May. And we've also seen that same line from Cote d'Ivoire as well. And it speaks to the importance of having that coordinated approach between the major African producers of cocoa and what that could mean on unlock in terms of the value the value capture we can have here in Nigeria.
Well, you know, the Western region made a lot of money from cocoa, and the Western region had this model of having a cocoa board. But sometime during the military administration, they liberalized and they dismantled a lot of the cocoa marketing boards, not only the cocoa, but all the other marketing boards. And what happened is the fact that we suffered from quality issues. So traditionally, Ghana and Ivory Coast have worked with the cocoa board. And if we do the same thing, then we put some sort of structure in place that could help us to be more competitive in the export market. So it is a welcome development.
We can't talk about trade policy, for example, without talking about infrastructure, because we understand that we're suffering from quite a huge gap in terms of that space. And I've seen that part of the fallout as well from the FEC meeting is that we're becoming members in the Asian Infrastructure Investment Bank. And I'd like you to speak to why this move is also pivotal for Nigeria.
Well, we all understand the need for infrastructure and the infrastructure deficit. But like I said, even the government's capital expenditure cannot meet that gap. There are many organizations that has been set up, but what is important is that government needs to look at private sector investments in infrastructure. And a lot of their loans that we're taking from maybe the Chinese should be put to the best infrastructure, for instance. Like the airports, for instance, are profitable. So there is infrastructure development that is quite positive that you could concession, or you could maybe get a loan from China, set it up, and then give it to private sector concessioning to help repay those loans. So we need to be able to have infrastructure concessionings that can pay its way back. All the trains that the Chinese have built for us, for instance, we're not recovering cost by putting freight and passenger railway on those things in a very aggressive manner to make it profitable and competitive.
All right, because now I wanted to move to the other aspect of this conversation, which is the report from the central bank on your earnings. First, it's important as we've seen that we're seeing this reports coming more and more, which we've seen in this new dispensation. But I'd like you to speak to the good, the bad, should I say the ugly as well?
Well, I think overall it's the good side of this is the fact that we know the position. So there's transparency, there's accountability, and so there is no levels of speculations. So I think it's important that we look at this balance sheet from 2 years ago in 2022 compared to today. So I think what the most significant aspect of it for me is the fact that they've reached profitability. And they've turned things around, and we know the position of where everything is. So if you drill down through the accounts, for instance, you could see that most of the fund they made was through their FX revaluation, contributed about 11 trillion to their bottom line. Ironically, the Ways and Means, which was looked at as an overdraft in 2022, has now been converted to government bonds, and that accounted for over 50% in their interest income, about 2.4 trillion from government securities. So it's interesting to see how they have transferred the Ways and Means to government bonds and accounted for it, because it's illegal according to Section 38. So I haven't seen that footnote in the central bank accounts as to how they've dealt with the Ways and Means, but obviously it's quite a profitable venture for them, because 2.4 trillion in income at the highest line of interest income is quite good. The other area which I think is quite critical is the fact that they have cleared out all the obligations, and all the FX forwards, the futures and the swaps have been settled, and it cost quite a significant amount of money. So they've taken a hit of close to 13 trillion in terms of provisioning for all those forwards, swaps, and those future contracts. So a lot of that uncertainty that's hanging has been moved on. So basically, going forward now, we have a clean sheet for which the central bank can operate from. But again, other things that are quite concerning is this severe increase in staff costs. I don't know what the adjustments are. And of course, we don't get Naira notes, but you see there's a significant increase not only in staff cost, but the cost of printing the Naira. Everybody's complaining that we can't get this cash. But, you know, in the whole year we're complaining you're not getting the cash, then the amount it's costing to print this money is actually spiraling, you know, significantly out of control. But I think all in all, what is important with this report is the fact that we can see the transparency, we know the position. And I think that what is even more impressive is the fact that we understand quite clearly from the JP Morgan report that the net reserves were actually down to about 3 billion. And within a year, they have made a 5-fold recovery, reporting net reserves of about $22 billion as of December 2023. So for me, I think, or 2024, that was, I think, the highlight for me in terms of that 5-fold recovery in net reserves. That really was a highlight for me. And you know my own campaign on the Ways and Means, so I'm anxious to see how they're going to explain how they reconcile the Ways and Means.
All right, they're waiting to see those footnotes, but thank you so much for your time today. Tilewa Adebajo, the CEO of CFG Advisory.